Hi, thanks for joining us and welcome to Boulay's webinar on pension pain, how rapidly rising interest rates can impact your retirement. My name is Nathan Faith, and I help direct our financial planning services here at Boulay Financial Advisors. As a comprehensive wealth management firm based here in Eden Prairie, Minnesota, we partner with families and individuals to help them with important financial decisions to help make and save them money. We always have our ear to the ground and occasionally come across surprising opportunities, including the financial phenomenon of how rapidly rising interest rates may impact your pension benefit. This may be relevant for those who are planning on retiring in the next few years and possibly for those already receiving pension benefits. This presentation could be the most financially rewarding 20 minutes of your life. Joining me today on this webinar are Charlie Steingass, President and Chief Actuary at Cash Balance Actuaries, and Christina Alsby, Manager of Financial Planning at Boulay Financial Advisors, whom you'll hear from both shortly. As you probably know, with rising inflation, this has been quite an interesting year in our financial world due to the cost of just about everything increasing in price significantly. Near the end of last year, the rate of inflation jumped very quickly. Chronically high inflation is a very concerning issue and creates many problems that occur if not addressed directly. Historically, the most common economic lever to pull is for the central bank to raise its stated interest rate, which is called the Federal Reserve rate. Practically all forms of lending are sourced from this rate, which raises the cost of borrowing practically everywhere and for everything. The central bank tinkers with this interest rate all the time. Here's a chart that illustrates how the interest rate has moved over the last 25 years. By historical standards, the interest rate we are at today, which is about 3%, is not that high. We were at these levels just 3 years ago, and the rate was about twice this high 15 years ago. The key observation is the speed in which interest rates have risen. Normally, it takes 3 to 4 years for interest rates to rise 3 to 4%. Interest rates have risen 3% in just 7 months and will likely rise even further by the end of this year. The central bank has signaled it will raise interest rates twice more to about 4.5% by early December. You may be thinking, I'm near retirement. I don't plan on borrowing a lot of money anytime soon. So why does this matter to me? Every liability is another's asset. Interest rates matter, especially regarding one of your largest assets, your pension. Let's take a look at why. First, every pension benefit is calculated based on a combination of your salary and your service. You earn a percentage of your pay every year of service, and once you hit a certain age, you're eligible for a lifetime of pension payments. In this example, a pension would pay half of one's final salary of $120,000 beginning the first year they retire. Notice that interest rates do not seem to be part of this equation. However, the pension plan needs to set aside a pile of money to sustainably pay your $60,000 benefit every year. It needs to set aside $60,000 for the first year's payment, but a little less for the next year's payment, a little less for the next year going forward. The key is that the pension plan invests those dollars for you in bonds, which pay interest, and other assets, such as stocks, which fundamentally should earn more than bonds as they are riskier investments to own. Thus, as interest rates rise, so does the growth rate the pension plan must use to calculate the lump sum amount it needs to set aside and invest for you. This calculation is commonly called a present value calculation and would be listed on your pension statement as a lump sum benefit. Let's continue with our example of how rising interest rates can affect the value of a pension. If the pension plan could earn 5% per year on its invested money, it would need to set aside about $950,000 to pay out the $60,000 annual pension for the next 3 decades. but it only need to set aside $875,000 if the interest rate was just 1% higher or 6%. Just $800,000 if the growth rate was 7%, $725,000 at 8%, and $650,000 at 9%. The math is a bit different for each pension, each person, but roughly the value of a pension drops 7 to 10% for every 1% rise in interest rates. Let's hold on to that thought for a moment. As we saw, the value of your pension may be reduced substantially as interest rates rise. But what has happened so far this year in the markets? Here's an illustration which showcases how major classes of investments have responded to the rising interest rate environment. A diversified basket of bonds is down just under 15% so far this year. The US stock market is down over 20%. Riskier stock markets outside the US are down 25 to 30%. Real estate is down over 25%. Practically everything you can invest in is down significantly this year. But notice the squiggly lines. The investment markets have responded to the news of rising interest rates on a minute-by-minute basis. However, pension plans do not. Like a groundhog, pensions have been peacefully hunkered down in their proverbial burrow. Pensions only peek their head out to observe the financial landscape once per year. Charlie Steingast will speak to the possible timing, but many pensions have not yet adjusted their calculations for the rapidly rising interest rate environment we've been experiencing all year long. Now for the potential big opportunity. Life rarely provides us the ability to turn back time, to ask for a redo, especially with investing. But if your pension is not yet reset for the current interest rate environment, you may be able to retire and cash out before your pension would experience a significant reduction in value. In our example, one may have the option to walk away with $950,000 pension benefit before it drops nearly $300,000 in value. You could then fast forward back to the present and invest that larger payment into the very markets that have already experienced significant pain of their own and will be well positioned for higher expected returns in the years ahead. Frankly, the best of both worlds. Sell high, buy lower, have your cake and eat it too. Christina will review an actual client case shortly, but that client discovered that he could retire a couple of years earlier than he had planned, draw a pseudo severance check from his rollover, and actually be financially better off than had he worked the next several years and had instead chosen to ride the market adjustment down on his pension benefit. Now, Charlie, our pension expert, will speak about how you can identify if this opportunity may apply for you.
Thanks, Nathan. So first, I'd like to go into just a quick little basic synopsis of how your lump sum is calculated. So for this to work for you, first of all, you have to have a pension benefit. Your company has to allow for lump sums of your pension benefit. If they don't allow for lump sums, then you're just going to get your monthly annuity no differently than no matter what the interest rates are. But most pension plans these days allow for you to convert that annuity stream of payments into a lump sum and roll it over to your IRA or 401k plan or something like that. So first of all, in order to figure out how your lump sum is calculated, you got to find your accrued benefit. You should be getting a participant statement from your pension plan sponsor at least once every 3 years, but probably every year. And it'll tell you your accrued benefit. It might even tell you an estimate of your lump sum on that participant statement. So that's the easiest place to look. If you don't have that handy and you know the plan formula, you could probably calculate yourself. Like Nathan went through, it's usually some percentage of your earnings payable at your retirement age. So once you calculate your accrued benefit, you can then figure out the present value of it, which is done. The IRS has one of kind of the greater of two methods that they use to calculate your lump sum. The first is your plan will have a stated actuarial equivalent interest rate and mortality table to use. So that's kind of a floor benefit that you get. And then it also, the reason we're having this webinar is that it depends on what we call 417E interest rates and the current mortality table. And so Code Section 417E was put in so companies couldn't use artificially high interest rates for calculating these lump sums. They had to use current market interest rates, and those generally get reset once per year, like Nathan was talking about. So that's why this opportunity exists. If you're, we're kind of assuming you're in a calendar year plan. So your calculations were based on interest rates back in 2021, which were much lower than the interest rates are going to be at the end of 2022, which is what is going to be used to calculate your pension lump sum if you take your benefit in 2023. So that's why the timing is critical here. You don't have much time left if you're, this assumes a calendar year plan. Not all plans are calendar year plans. You might have a plan year end from May 1st to April 30th or something like that. But the idea remains the same, even if you didn't get a chance to do this in 2022, as long as interest rates keep going up and up and up, the idea will remain valid until the current interest rates pass whatever that actual equivalent interest rate floor is in your plan. From your basic finance stuff, you'll remember that the lower the interest rate is, the higher your lump sum will be. Well, kind of what Nathan was talking about back there. The higher the interest rate is, the lower your lump sum will be. So if you can take your lump sum pension before interest rates start rising, you'll get a larger amount today than you would if you waited until interest rates were higher. So go to the next slide. The next thing you got to figure out is, hey, am I eligible to take a lump sum? So like I said before, not all plans allow for lump sums. So you can check your plan document to make sure your plan does allow for them. Your plan also needs to be well enough funded to allow for lump sums. That might be another reason to take it this year. So that funding calculation is also done once per year. We call it an AFTAP certification. And so for some people, the AFTAP needs to be above 110% if you're one of the highest 25 paid people at your company. For the rest of us, the AFTAP only needs to be above 80%. Basically, you need to have enough money in the plan to, ensure that they can pay out everybody else even after you leave. And so that gets calculated once per year. So again, because of the stock market downturn and bond market downturn, when they recalculate this as of the first day of the plan year, your plan might not be as well funded as it has been in the past. So it might be, you might only have a chance to take these lump sums now, and you might not have as much of a chance later if the plan's not well enough funded. So you need to check on that. Besides that, probably the most important part is you do need to have a distributable event to take a lump sum. So I kind of listed all the different distributable events that might happen. If you're over age 59 and a half and the plan allows in-service distributions, you don't even have to retire. You could keep working at your company and just take out a lump sum of your pension. If your plan doesn't allow for any of these things, by the way, you could ask and they could change it to allow for that. They might not listen to you, but depending on your clout at the company, maybe they will. If you have retired or you've left the company for any reason, even if you're working at a different company, if you had a pension from your old company, most plans allow for lump sums for terminated employees. So if you're, old enough and don't work at the company, even if you're younger than 59 and a half, if you're no longer working for the company, you should be eligible to take a lump sum and roll that over to an IRA or your 401k at the new company. The plan you're in could terminate. So some plans get to the point where they're done providing retirement benefits, whether it's because your company was sold or they just decided to replace the pension plan with another kind of plan like a 401k or something like that. Once the plan terminates, most people are usually eligible to take a lump sum at that point. If you're an annuitant and you're already taking monthly payments, it's possible that your company would allow a lump sum window. Basically, they would allow you the opportunity to convert your annuity payments, your pension payments, into a lump sum and just take it out all at once. So that might be a little bit rare, but certainly something you could ask about. Also, if you're divorced and your former spouse has a pension, there's a chance that you would receive a quadro, and you can take that quadro possibly as a lump sum. So that might be an option to take advantage of these rising interest rates and get a lump sum. All right, so next step is you got to figure out if you are actually eligible for that lump sum. So, you could look at those things we just talked about. You should have what's called a summary plan description, and you also have the right to request a copy of the actual plan document, which is the language and rules governing your participation in the pension plan. That in there, you should be able to find whether your plan allows for lump sums or not, and who's eligible. And if you're curious about if your plan is well enough funded for a lump sum, every year you're required to get an annual funding notice, or if you're in a very small plan, a summary annual report. That should tell you what your AFTAP funded percentage is. So as long as that's over 80%, there's a good chance that you can qualify to get your lump sum. The plan document, if you get a copy of it, which you can do by law, they have to give you a copy of the plan document if you want it, if you request it. So you could go to HR and say, hey, I want a copy of my plan document. In there, it will tell you the stability period and look back month in the actual equivalent section. So if you really like to dig into this and learn it yourself, it'll basically tell you what month they are using for lump sum calculations. So, if it was a calendar year plan and they say a 2-month look back, for example, you would look back to the November 2021 interest rate or interest rates to calculate your lump sum. And you probably don't have to calculate it yourself. You need to hire an actuary to do that. So in reality, what you're going to do is you're going to go to your HR department and say, hey, I think I'm eligible for a lump sum. Can you please prepare the paperwork for me to take that lump sum? And they'll probably just do it for you. But if you wanted to get a rough estimate, you could attempt to do it yourself using all these methods, or you could call your friendly actuary and they could probably help you out with it too. Anyway, that's about all I have on how to actually go about getting your lump sum. Next up is Christina. She's going to run you through a case study of how awesome it could be if it works out for you.
Yeah, thanks, Charlie and Nathan. During the next few minutes, I'm going to walk through a case study to showcase how the changing interest rate environment and direct correlation to your pensions can impact a financial plan. This scenario is based on a client we recently encountered, but today we're going to call them Jim and Jackie. They're in their early 60s, 3 grown children and 2 grandchildren. Jackie is retired. Jim earns about $250,000 per year with a firm he's been at throughout his career. Today, their living expenses, excluding taxes, are about $125,000 annually. Their total net worth is approximately $4.7 million, and this includes the $1.77 million lump sum pension option Jim has through his employer. This lump sum benefit reflects the lump sum offered currently prior to interest rate adjustments set to take place on November 1st, 2022 for Jim's plan. But how does the expected interest rate adjustment on November 1st affect Jim's lump sum going forward? On the right side of the screen, we can see how the lump sum benefit is calculated. If Jim took his pension as an annual annuity with a 100% joint and survivor benefit, he would receive $110,580 per year for the rest of his and his wife's life. The lump sum needed to sustain that income stream throughout their lives is dependent on the return Jim and Jackie can expect to earn if they invest the dollars. As Nathan spoke to, the higher the expected growth rate, the smaller the lump sum needed to sustain the same income stream. Currently, before the interest rate adjustment to Jim's pension plan, the expected growth rate is about 5%. meaning the net present value or lump sum benefit is equal to approximately 1.79 million, which is approximately equal to the 1.77 million that Jim's lump sum benefit is currently valued. But when interest rates reset on November 1st within the pension to reflect the new Federal Reserve rate, you can see the impact on the lump sum value on the right side of the screen. A 3% increase in interest rates, which correlates to expected growth rates, decreases the expected lump sum from 1.77 million to about 1.3 million. This is a 28% adjustment or 9.5% change per 1% increase in interest rate, a huge difference resulting from retiring one day later, October 31st versus November 1st. Utilizing our financial planning software, we can quantify the decision to retire prior to November 1st. Here's a projection of Jim and Jackie's wealth, assuming they take the lump sum of 1.77 million prior to November 1st, but receive pre-2022 expected investment returns of 5%. As Nathan spoke to, markets reprice daily, and year-to-date bonds and stocks are down 10 to 30% in value. Because of this, Jim and Jackie can expect greater returns into the future by investing into a down market today. With expected annual return going from 5% to 6%, the opportunity to invest the pension received at a high valuation into a down market creates even greater value. Over Jim and Jackie's lifetime, the value of 1% greater return on Jim's pension dollars is worth about $1 million. If Jim retires post November 1st, after the interest rates within the pension have been adjusted, thus taking the reduced lump sum of 1.3 million, the impact to their plan is stark. Even accounting for the ability to invest into a down market and receive greater annual returns than 1 year ago, the lifetime impact of the retirement timing decision is worth about 1.13 million. This is the value lost compared to taking the $1.77 million pension and receiving annual investment returns of 5% on those dollars. So finally, let's put the two opportunities together. Taking the pension at a high valuation, and 2, investing into a down market, providing for greater future annual returns. On the left side is the graphic showcasing Jim taking advantage of both those opportunities. On the right, the one variable difference is that Jim delays claiming his benefit, thus taking the reduced lump sum benefit of 1.3 million. So although Jim receives the same annual returns in both scenarios, the spread between a 1-day retirement timing decision is equal to about 2.15 million over Jim and Jackie's lifetime. We greatly appreciate you taking the time to watch, and hope our presentation provided you food for thought. If you have a lump sum that you qualified for through your employer, if you were not previously familiar with Boulay Financial Advisors, we provide comprehensive wealth management services to individuals and families. Today, we focused on the opportunities surrounding pensions, but we see your pension as one piece of your overall comprehensive financial plan. Our job is to help you make decisions around your money that are going to align with your personal and your family's goals, values, and dreams. If we can help, please reach out. You can email us at learnmore@boulaygroup.com. Again, that's learnmore@boulaygroup.com.